So this is going to be a short video of terms, accounting terms that will be needed for your case. So it's not comprehensive, but hopefully it will be helpful for those of you that really just have no financial vocabulary, which is fine, as you probably shouldn't. So a lot of it's going to be foreign. It'll almost be like a foreign language to you. But we know that accounting is the language of business, so we have to understand some basic things. And especially once you get into more of a managerial role while you're doing budgeting and looking at financial statements, it's going to become apparent quickly that understanding these terms is pretty important just to get the basics. So with that, the case is going to have you look at or have you construct two financial statements. The income statement, which tells how much a business makes for a given period of time, and the balance sheet, which tells how much the business is worth, what's its value at some given point in time. Typically, these are done on a monthly, quarterly, and annual basis. In publicly traded companies, financial statements are required to be produced on a quarterly basis. They're called 10Ks. On an annual basis, they're put in something called an annual report. But nonetheless, these financial statements of any type of organization, for or not for profit, private or public, are necessary to be prepared to look at the financial health of an organization and also to meet some legal minimum legal thresholds. So we'll look at the income statement first. In your case, you're going to be listed, there's going to be many accounts that are listed. Those accounts are in no particular order with a dollar amount, so this would be their balance at the end of, let's say, a month for this example. Accounts are specific dollar amounts that can either be on, but not both, either be on the income statement or the balance sheet. Accounts that go on the income statement are accounts that would be related to revenue, cost, and expenses. So if we look at the revenue first, revenue, the other word is a category. It's called actually a classification. So an account that's classified as a revenue almost always is just going to be one, and that's going to be sales. The sales actually in a detailed income statement will be broken down even further. They'll subtract out sales discounts, allowances, and returns to get net sales. For this case, I'm just giving you sales, and we're going to assume that it's just net sales. So that's where we start with. The income statement starts with sales. And then we subtract out another classification or category called cost of goods sold. And cost of goods sold is the dollar amount that you paid out as an organization to sell whatever you're selling, or whatever, whether it's a service or it's a product. The cost of goods sold is either what you bought it at or what you manufactured it at, so like the ingredients. It can be fairly not complicated once you understand it, but there's a number of accounts that go into finding out the cost of goods sold. Beginning inventory, transportation in, purchases, discounts, transportation in. All of those we are not going to look at for this case. I just gave you the cost of goods number. But just know in the example in the book on 454, it breaks down how you actually get that cost of goods sold number. I actually just gave it to you in the case. So now we have sales and cost of goods sold. Obviously, we're going to subtract those two and get a number that you will not find in the case, but you need to create and put down. And that's what's referred to as gross profit on sales. So for numbers' sake here, for easy numbers, let's say our sales was 100, our cost of goods sold was 40. That means our gross profit on sales, what we made from just selling, is $60. But that's not what the income statement is all about. We need to continue on the next account classification, which is expenses, or our operating expenses. Operating expenses are all those things basically that end with the word expense. Now sometimes it won't, but almost always it ends with the word expense. These are what often is referred to as our overhead. Things that occur whether we're running or whether we're selling 1 unit or 100 units, they're still going to occur. In the example that I gave you, I subtracted, or I did not put in a lot of the account names that are in the example in the book. I just made it pretty easy for you and listed those expenses. You would total all of those up. You get a line that you'll now create called total operating expenses, and you'll subtract total operating expenses from our gross profit on sales. The difference there is our operating income. I will say the only expense that you do not put in that long list of expenses is income tax. That's separate. So after we take our gross profit on sales, we subtract out our operating expenses, we get something called operating income. Then we subtract out our income tax, because we get taxed on the operating income amount, and we get net income, which is our final number that you would label. That's the income statement. It tells how much an organization made in a given period of time, whether it was profitable or not profitable. If it's profitable, in accounting they say you're in the black. If it was a net loss rather than a net income, then you're in the red. And you can see where the numbers are coming from. If you want to, as in the case it said you need to then write 2 to 3 sentences on what this means, you can say this company is or is not profitable because, and then you can fill in the blanks of words based on your understanding of the income statement you created. You can also do some analysis, financial analysis. In the book it tells about a simple one, which would be your gross profit margin and or your net profit margin, which are easy statistics to calculate. And you could, if you don't have to, but you could use that in your explanation as well, commenting on whether you think that this business is doing well or not just based on this one little snapshot. Of course, in the real world, we'd want to compare it to other things. So in the case, all of the accounts that you believe are revenue, cost of goods sold, expenses, you would pull out of there and create a separate statement called the income statement, and that would cross them out. And then obviously everything left over is going to go on to the next statement that you'll create, which is the balance sheet. The balance sheet is used to analyze what a company, what it's worth. So if they ever wanted to sell a company, or a company wanted to know what are we worth today, you would look at their balance sheet. It also is a good judge of their liquidity, their ability to pay their bills on time. The balance sheet always is the fundamental accounting equation. So when you read your chapters, they talked about the accounting equation. It's fundamental. It always balances. And that accounting equation is A equals L plus OE, or assets equals liabilities plus owner's equity. So assets, any account that's classified as an asset is anything that can be measured in dollars and has value, whether it's tangible or intangible. So we're not going to put sales in there because we already have that as an income statement item. So you might say, wouldn't sales go there? No, it does not. So that's not what it is. It is anything that has value that can be measured in dollars, tangible or intangible. Typical asset accounts would be cash. Sometimes it's called cash in bank. Accounts receivable, people that owe you money from sales. Equipment, land, buildings, all of those, some types of investments, all of those things would be referred to as assets. So you list all the assets, you total them up, and you get a number called total assets. That's going to hang out for a little bit because we still have to have that equal to the next two sections, which would be liabilities and owner's equity. Also note that on the example in the book on page 450, they broke the assets down into current and long term. They took into account depreciation. For simplicity's sake, we're not going to do that. We're just going to list assets and then our total assets. And we'll do the same for our liabilities. Liabilities can be broken up into short and long term. What are liabilities? Any account that has a payable next to it or a loan is going to be referred to as a liability. It's someone else's financial claim. So we got an asset, right? Let's say we bought a delivery truck. And that delivery truck, we actually took a loan out on that delivery truck. That is, though, so we have it balanced in the equation, that $10,000 delivery truck, in this case I'm making the number up, would be equal to the $10,000 liability that someone holds on the other equation. And so we have balance in the accounting equation always. A liability, again, is someone else's financial claim to the asset. Obviously, when those liabilities draw themselves down, that gets transferred to our financial claim to the business, which is an equity account or an owner's equity account, or in a publicly traded company, shareholders' equity. So liability is anything that's going to be a payable or an amount that we owe somebody. The next classification again is owner's equity, or in a publicly traded company, stockholders' equity. That classification could be a number of different accounts in terms of shareholders' stock and retained earnings. For simplicity's sake, I just put, I believe, total owner's equity. So in the balance sheet on the right side, where you're totaling the numbers, you had total assets would be equal to, let's say, I'm making the number up here, $20,000. That would be equal to liabilities, let's say in this case of $5,000 and owner's equity of $15,000. So you have $20,000 equals $20,000. Those two statements, the income statement and the balance sheet, are used not only by financial managers, but they're used by all managers and organizations because it really goes to the value proposition and how we can make those numbers stronger to be a continuing going concern.